Hi, and welcome to the December Market Thoughts Update. My name is Brad McMillan. I'm Commonwealth's Chief Investment Officer, and as you can probably tell, I have a very bad cold. I apologize for that, but we'll just have to do the best we can. November was actually a very strong month for the U.S. equity markets, capping a string of recent strong months. What was interesting about this month, though, was the fact that although the U.S. did strongly, other areas did much less well. If you look at the relative performance of the U.S. against developed markets, that's the EAFE line on the chart, or against the emerging markets, that's the VWO line on the chart, you can see that in fact the U.S. continued to power ahead while those fell back. There's a couple of reasons for this. First of all, the U.S. economy continues to do extremely well. If you look at U.S. employment, for example, you can see that it continues to improve. If you look at the chart of the initial unemployment claims, these are on a weekly basis, these are the number of people who are filing for unemployment benefits. You see it's been consistently declined, then it spiked up the start of October with the government shutdown, but it's continued to decline since then. This suggests that employment, in fact, is doing really well. The second component is wage growth, which continues to grow at levels that are healthy and at levels that are increasing. In fact, we can expect them to continue to increase. That's exactly what we're seeing. So the strong U.S. market performance is actually based on good economic fundamentals in the U.S. Whereas if you look around the world, things aren't quite as good. Europe, for example, is showing signs of recovery. If you look at Ireland, if you look at Spain, they're looking to exit from the support programs that the European Central Bank has put in place. Even Greece recently had their credit upgraded. They're doing really well. But Europe has some drawbacks as well. France and Italy are both looking as if they might slip back into recession. So there are concerns out there, and that weighed on the EAFE index. If you look at China, the real news was the third plenum this month. That was a very good thing. It suggested the Chinese were going to do all of the right things. They're certainly saying the right things, and that's a good sign. But keeping growth at the levels they've been expecting is going to remain a challenge, and that also started to weigh on emerging markets. Another factor that weighed on emerging markets was the Federal Reserve's policy. This is something where the Fed will taper eventually. That will have a negative effect on emerging markets, and that is something that they are still struggling to come to terms with. On the whole, though, from a U.S. perspective, as we move into the last month of the year, things are actually going quite well. The market has done incredibly well this year. The economy is accelerating. The recovery is real and well supported. And while risks remain elsewhere in the world, we're in a pretty good place right now. I'll talk to you next month, and I hope I won't have this cold then. Thank you very much.